Hello, everyone. My name is Sean Spalding. I am your instructor for Financial Accounting, Business 120, Section 1315. I am going to be putting these lectures up for you each week or for each chapter to try to go over some of the materials in a little more depth, add some context to what you're reading and the problems that you're going through. The goal here is to kind of go over some housekeeping items first, and then we'll jump into a quick intro and jump into some of the important aspects of Chapter 1. Okay, so class flow, as you've seen, hopefully everybody has access to the class in Canvas. Pretty straightforward. When you go to the home page, you'll see all of the modules. Each module has the assignments. The assignments are pretty much going to be the same each week. You're going to have to write a discussion due by Wednesday, and then you're going to have to respond to two of your classmates by Saturday. You'll have a reading assignment, which is typically going to be the chapter 1, chapter 2, chapter 3, etc. And you'll have a homework assignment, and that's going to be in My Lab and Mastering. And so that's pretty much it. Pretty straightforward, and it's going to be about the same each time. Then we have exams. There's 3 exams. They are weighted equally. They are not necessarily going to build on each other. It's going to be you'll take the first exam, which is going to be on chapters 1 through 3. Then you'll take the second exam, which will be chapters 4, 5, and 6. And then you'll take the third exam, which is also the final exam, which is going to be on 7, 8, 9, and 10. So, pretty straightforward as far as that goes. If you have any questions, feel free to send me an email or send a message in Canvas. Okay, so now let's jump into some of the materials. So the first thing I wanted to discuss is to kind of give you why it's important. Why is financial accounting important, and what is financial accounting? So first off, financial accounting is not, we're not going over your personal finances. You're not going to learn how to balance a checkbook. You're not going to learn how to budget anything personally. This is all about business. How do we keep score? How do businesses keep score? Okay? And the other part of this is, why is it important? And, for me, just to give you a little bit of background, I'm an attorney, and my practice, I specialize in taxation law. So, as you can imagine, financial statements are very important. I have to be able to understand the income statement, the balance sheet, and what entries are showing up, what accounts are showing up. Are they being reported properly? A lot of times out there, you're getting bookkeepers or other accountants that are doing things improperly. You're getting the wrong numbers, or you're getting the clients that do the books and record keeping improperly, and you have to go back and reclassify everything if necessary, or rework the books so that you get accurate numbers. You cannot make informed decisions without accurate numbers, whether you're an attorney, whether you're an accountant, CPA, or whether you're a business owner. So all of this comes down to the accuracy of those numbers will lead to whether or not you're able to give or make informed decisions, or the best decision possible. Okay, so with that said, we'll jump into a couple of the important aspects of Chapter 1. The first being the types of businesses. And so we see this list here that's been up on our screen. And we've got 5 general types of business: sole proprietorships, partnerships, corporations, S corporations, and limited liability companies. So we'll go through each of these generally. So a sole proprietorship, to start off, is it's basically a person. It's an individual that is conducting a business, whether it's a plumber that's just out there providing plumbing services to other individuals, their customers, their clients, whether it's an attorney, accountant, contractor, construction, carpenter, whatever the case may be. You can operate all types of, all sorts of industries as a sole proprietorship. For tax purposes, the income is going to be taxed at your personal rates. The benefits, ease of formation. There really is no formation. You might have to, file for a business license in the city that you operate. There's no double taxation, so those are some of the benefits. And then the drawbacks are really the unlimited liability. So any kind of creditor situation, any kind of lawsuit, you and your personal assets could be held or would be held liable to satisfy whatever judgment might be against you. And then moving on to partnerships. So partnerships are very similar to sole proprietorships because there's no separate entity. A partnership really is just two or more individuals that have set out to operate a business for profit. And that's pretty much what it boils down to. So you have two people. They don't even have to have a written agreement. They don't have to register anything with the state. Now, there are state registered types of partnerships, like limited partnerships and limited liability partnerships, and things like that. But we're not going to get into any of that. Just a general common law partnership is really a pass through or a disregarded type entity where, again, the income flows through to the partners. Again, ease of formation, no double taxation, and then you get the benefit of kind of shared knowledge, and you have another person there to cover down perhaps when you want to go on vacation or something like that. And just like a sole proprietorship, there's unlimited liability to the owner. So each of the partners are liable 100%, including their personal assets for any kind of judgment. So definitely something to be aware of. And then moving on to corporations. Corporations are basically regulated by each state. So here in California, we have our own rules for how to form a corporation, what is required to maintain a corporation, et cetera, et cetera. These are, again, state law entities. And this particular type of corporation that we're looking at for tax purposes would be referred to as a C Corp because it's taxed under Subchapter C of the Internal Revenue Code. And what that means is basically the corporation, it does or is subject to kind of two layers of taxation. One, the corporate layer. So the corporation will figure out what its net income is and it'll pay income tax on that. And then if it issues dividends to the shareholders will also have to report those dividends as income on their tax returns. Some of the benefits are raising capital and the limited liability protection of a corporation. Those kind of go hand in hand, right? People are more willing to put up money if they don't have to worry about the actions of somebody else creating a liability for them. And so what that means is, shareholders aren't necessarily the people that are running the business. So typically a shareholder invests money and they may have some voting rights and things like that come along with investing the money, but you have a board of directors. The board of directors hires the officers. The officers manage the day-to-day operations of the corporation, and that means hiring other employees, et cetera, et cetera. And so those individuals may end up doing something that creates a judgment against the corporation or some other action against the corporation, and the shareholders typically will not be held personally liable, meaning that they're protected from these creditors coming and taking their personal assets for the debts of this corporation. And so that gives them a little bit more confidence to put their money into a corporation. That's why typically it's the preferred method if you need to raise capital. My apologies for the phone interruption. Okay, so moving on. We're moving on to the S Corp. So the S Corp is a colloquial that we use for a corporation that has made an affirmative election to be taxed under Subchapter S of the Internal Revenue Code. And so these corporations, again, they're formed the same way that a corporation would for this taxed under Subchapter C. So a C corporation, S corporation, they're formed the same way, typically speaking. And the S corporation, again, they make this election to be taxed under Subchapter S. Because they're a small business, they have fewer than 100 shareholders, they're going to issue a single class of stock, etc. As long as they qualify to be taxed as an S corporation, they can elect to do so. And what that does for them is gives them pass-through entity treatment so that the income, again, flows through directly to the shareholders, and the shareholders pay tax at their rates, as opposed to the corporation paying tax and then issuing dividends, and then the shareholders also paying tax on it. So that's pretty much, I think, the extent that we need to go over the S corp. And then we'll move on to the limited liability company, limited liability company LLC. So try to keep this straight to the extent that you can. It's not a corporation. So some people here say, "Oh, it's a LLC, a limited liability corporation." That's not what it is. It's a limited liability company. It is a fairly new, within the last 50 or 60 years, state law created entity that is not a corporation, but it does have some of the benefits that a corporation have, namely the limited liability, right? So the members, the owners, they don't have unlimited liability like a sole proprietorship or a partnership. So they get that protection. And then there's some differences as far as how they're taxed. There's a lot of discretion that goes into the LLC. And they can essentially elect to be taxed however they want. So if it's a single member or single owner LLC, they default to a disregarded entity, which means they would be taxed like a sole proprietorship. If it's if there's more than one members, it defaults to a partnership for tax purposes. But either of those two can elect to be taxed as a corporation, either a C corporation or an S corporation, so long as they meet the requirements. So that's pretty much what we're talking about. Those are the types of entities. For our accounting class, we're really, I think it fits most closely in this environment with a corporation. So we're not really necessarily dealing with capital accounts of a partnership or basis inside and outside with an S corp. We're just kind of sticking to kind of a simple formula for a corporation, just to kind of give you the fundamentals. And then as you go through the classes, if you're going to pursue becoming an accountant, you'll get into partnership accounting, you'll get into all of that. But for our purposes, pretty straightforward. Okay, so moving on to recording business transactions, and I really here just want to talk about the fundamental accounting equation here, right? So you've got assets equal liabilities plus stockholders' equity. And you see in the parentheses what the business owns is on the asset side, and who provides the money is on the liabilities and equity side. So liabilities are so perhaps money borrowed from a bank. So that would be a liability that the company owes, and that money that they borrow would be on the asset side. So it would balance out, right? Same thing with stockholders' equity. You've got common stock, you've got retained earnings. So whether it's money contributed to the corporation by the shareholders or the owners, or it's money earned and held in the retained earnings by the corporation, and then whatever money that would would be there would also be on the asset side, right? It'd be a cash account. So that's, again, this is the fundamental accounting equation. These have to balance out. This is basically what your balance sheet is going to look like. It's going to have assets on the left side, and then it's going to have liabilities and equity on the right side. Okay? So let's take a little bit closer look at it, and we'll just kind of look at the expanded accounting equation. So again, here you see assets equal liabilities plus stockholders' equity. And then stockholders' equity can be broken out a little bit further. You've got common stock, like I just mentioned, and retained earnings. So common stock is from selling stock to the shareholders or additional paid-in capital or additional capital contributions by the shareholders. And then retained earnings is going to be from the operation of the business. So as the business is selling whatever good or providing whatever services, it accumulates income that will go into the retained earnings account. And again, that's all part of stockholders' equity. Okay, pretty straightforward. And then just real quickly, we'll talk about the preparation of financial statements. Now, of course, in Chapter 2, we'll get in a little deeper into recording transactions, general ledgers, trial balances, and all that, and we'll talk about the actual accounting cycle. But this is kind of an introduction to the financial statements, which will be created during the accounting cycle, right? So you'll always have to create the income statement first, then you'll create the statement of retained earnings, the balance sheet, and the statement of cash flows. So we'll get into more of that in Chapter Two's lecture. If you have any questions, feel free to reach out to me. Otherwise, we'll talk.